and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, real estate, insurance, loans, and everything else about your money. We, of course, would love to make this conversation and this show interactive, so please feel free to write in with all your questions and your queries, and we'd be more than happy to take it live with our experts. I'm Samina Nalwala, and let's look at the top stories of the day. Markets finally snap a 5 day losing streak. Bulls make a comeback and take the Nifty to 24,300, led by financials, metals, and IT stocks. Broader markets that sold off substantially last week recover in today's trade. Bank Nifty performs with a gain of 472 points on back of strong earnings from ICICI Bank and Shriram Finance. Both ICICI Bank and Shriram Finance were top gainers on the Nifty, up in the range of 3 to 5%. Most analysts believe this is a dead cat bounce and still believe that the markets in the near term are expected to remain volatile. From equities to currency, the Indian rupee opened flat at 84.075 against the US dollar amid concerns about tensions in the Middle East and US elections. Experts predict that the rupee will remain range bound for the foreseeable future, but will closely track what the dollar index gets up to. The dollar index, along with the 10-year bond yield, has been on a winning streak in the US on expectation of a better and strong recovery in the US economy and anticipation of Trump coming back, which could push reflation trade. Well, in other news, crude has eased off 5%, and on back of that, the dollar has once again, along with the rupee, gained some stability. Well, from there to the much anticipated listing of October has been Vari Energies. The stock listed today in trade with phenomenal gains. In fact, Vari Energies opened on the exchanges at 10 a.m. this morning with a gain of 69%. On the NSE, the stock started trade at 2,500, up 66.3%. Remember, the stock was oversubscribed by 76 times by retail investors. However, towards the close of trade, there was some amount of profit booking, and the counter declined 10% from its intraday listing gains. Well, apart from gold, it's silver that we can't get our eyes off. As of 21st of October, silver has been the best performing asset class, gaining over 30%, followed by gold at 23%, while the Nifty itself has gained only about 23% in comparison to what the gold and silver have done. Silver did end the year ahead in 5 instances, gold in 7, and the Nifty has had the highest returns in the last, or rather remaining, 12 years. But despite silver's very strong performance, experts believe that the precious metal should not be a major part of your investment portfolio. A report recently indicated that silver should have a minimal presence in a diversified portfolio based on historical performance and asset correlations. It suggests focusing on gold and equities to maximize returns and minimize volatility is the best portfolio approach. But of course, we are in the midst of the festive season, which is kicks off. The bulls made a comeback in the equity markets. It's Dhanteras tomorrow, which means that all of us will be going out and buying gold. Well, to talk about gold and the role of gold in a financial portfolio, we have with us Loai Navlakhi, MD and CEO at International Money Matters. Hi, Mr. Navlakhi. Thank you very much for taking the time out to talk to us. I know it's excitement all around. We finally got into that much anticipated festive week. It's Dhanteras tomorrow, which means all of us will want to go out and buy some gold. To begin with, all our viewers and retail investors, what should they do? Should they go out and buy one sikka, or should gold be added to a financial portfolio from a structural and a strategic objective?
Hi, Samina, and thank you for having me here. This question about gold seems to pop itself every time there is a festive season, or, over the years, it's the time traditionally one goes to the jewelry shops and, you know, really spend some money. And I think, frankly, one needs to look at gold from an investment standpoint a little differently. Now, if you're going to go and buy jewelry which you like to adorn and put on, surely you can go ahead and do that. But if you're thinking of it from an investment standpoint, there are many different alternatives for you to buy gold. And I'm not so sure whether it needs to be done just from an investment standpoint tomorrow. So if you're doing it for the religious, traditional, festive purpose, go ahead and do it. Small amounts won't harm you anyway. But I'm sure you have more questions to ask me on the
Yeah.
on the concept of
No,
investment.
why gold has never hurt, and that's why the joke or the truth is that Indian housewives are probably the wealthiest individuals all over the world for good reason, right? So I do understand that gold has picked up significance, largely also because the accessibility of paper gold. But I want to talk to you first about physical gold, and I bring this up because while I know we underplay the fact that women like us love gold and we keep adding gold to our closet in so many ways or lockers, there is still some value to that gold. Wouldn't you agree?
No, no, absolutely. There is value to gold. So I think that traditionally, what I do understand is that people don't like to buy physical gold. They used to like to buy jewelry and then think that that's an investment in gold. And unless you are wearing it, if you're just keeping it in your locker thinking it's going to appreciate in value, the problem is that at some point you want to trade in that jewelry item and convert it to something else, and then you suddenly realize making charges and things like that are getting deducted. So if you're just buying physical gold and looking at it from an investment standpoint, that's fine as long as you are not worried about how to store it, where to store it, uh, fear of safety and robbery, etc. Then yes, gold is a good investment option even in the non-financial world sort of method. It's just that you have to
Right,
keep in mind, taxes, etc. Now, if you're buying it officially with from your bank, etc., then you pay long-term capital gains if and when
right,
you sell it.
right.
Uh,
Look, why gold is not an either or when compared to equities, from what I understand. Right. So now let's talk about gold from a financial portfolio management standpoint, and that's where you're the expert, right? So why don't you start by telling us? You must often hear individuals or clients who come and tell you, "We like gold. We believe in gold. It's not volatile. It's not equity because equity." Individuals or investors have preconceived notions around the asset class. Do you feel that gold is a complementary asset to equity as opposed to a replacement to equity, even though both the returns of equity and gold over the long term average is exactly the same?
So I think if you take really long term, it won't be the same. If you're looking at 15, 20 years, then it won't turn up the same. But I do think that as financial advisors, financial planners, we do recommend that gold is a good investment for you to have. Typically, we would suggest 5% of the portfolio when things become uncertain in financial markets. You would then try to increase, or you could increase your allocation to gold to even 10% of your assets. It can happen in one of two ways. You're putting in more money, or the rest of the assets just fall in value. So your share in gold sort of goes up. But essentially, you're using it to hedge against inflation, to hedge against uncertainty. Um, and in India, you have to keep in mind that the price of gold is dependent on three factors really. One is what is the international price of gold, because that's where the price of and the movement of gold really gets determined. But I think it's also linked to how the currency is moving, how much the rupee is depreciating or appreciating, and then the government keeps adding, reducing customs duty. So I think all these factors play a role in determining the price of gold. So you could have a period where internationally gold has fallen, but the rupee has depreciated. So in our gold holding in rupees, it's not moved at all.
Right.
So you have to keep
Right. So
that in.
those are right. So those are the global and domestic factors that impact the way gold has moved and will move. So in that case, before I talk to you about asset allocation, is right now a good time to increase allocation to gold, given that we have had a very strong run on the precious metal this year?
Yeah, so I was looking at 1 year returns, it's 49% in the international markets in gold. And we've not seen too much of a difference with the Indian returns, primarily because the rupee has remained very stable, except
Hmm.
for the possibly the last couple of weeks. The rupee has depreciated a bit. So to that extent, it does seem like it's like an afterthought for you to invest more in gold. But I think you always make investments not looking at the past but the future. Now, if we think that gold is a good hedge against uncertainties, there are tremendous amount of uncertainties in the world, right? There is the worry about the Middle East crisis. You don't know how Russia Ukraine is going to play out, what's happening in Korea, what will happen to the US elections. Indian equity markets, for now suddenly you're starting to see corporate results not being very good. Now, in all of this, it does seem right to allocate money to gold. So the way I suggest that viewers look at this is how much of your asset is in gold today. So let's say you calculate and find it's 2%, and we are saying that it should be a minimum of 5%. So at least go ahead and buy maybe 1% every week for the next 2 weeks, 3 weeks, so that you up it to 5%. Don't buy it all at one go. But if you're already at say 6, 7%, you need to take a call how uncertain you're feeling with all the global environment. If you're feeling really a lot uncertain, then go ahead and increase your allocation to 10%. If you're already at way above 10%, then I'm not so sure.
Hmm. So why that brings me to my next question, and I know you're an advisor, so you'd know this better than anybody else. It cannot be and shouldn't be a cookie cutter approach because everyone is different, everyone has different financial objectives, and more importantly, everyone has a different risk profile. So, for somebody who's middle aged with an average risk profile, still looking to create or in the wealth building stage in that sense, and who has a 50% or 60% allocation to equity, how much gold do you recommend he or she should add to their portfolio?
So if they have zero, like I said, if it's 60% equity, then if I'm looking at 10% of that amount, it'll be 6% of the total. That's the approximate amount that they should allocate to gold, even though they are in the asset building stage. See, the point is that we never know when markets take a pause or they take a U-turn, or they don't go the way you are predicting them to go in your investment in equities, etc. So I think it's a good idea to hedge. And if you feel uncomfortable, and I think it's the right thing to do, that feel uncomfortable about putting all the money in at one go, stagger and break it up and do it. You probably feel calmer about it.
You're right. I think timing the markets is a fool's paradise, right? It's time in the market. And I think the same rule applies to gold as well. Of course, gold has also become a lot more popular because it's also become a lot more accessible. And like you started by saying, right, the safety, the fact that you can now invest in gold by simply a click of a button, so paper gold in that sense, is now made available. Uh, in paper gold as well, you have gold ETFs, you have gold funds, and you have SGPs. You want to talk to us about the advantages, the attributes of each of those, and what your preference is here?
Yeah, so I think it really will depend on what's your time horizon and really what the purpose of that investment is. So if I am building it, listening to a financial advisor and saying there has to be an allocation to gold and my assets are going to grow over time, either because I'm adding more money or because my other assets will also grow in value, then I'm comfortable doing investing through sovereign gold bond. The sovereign gold bond is a scheme the government of India launched where if you hold on for the entire tenure till maturity, which is 8 years if you are investing through the primary issue, then there are no capital gain. So if the price of gold moves up from 10 rupees to 15 rupees, then the entire gain is tax free. Um, I'm just giving an example of 10 and 15. We know that it's not 10 rupees and 15 rupees. What happens with the sovereign gold bond is that apart from the value being protected and your capital gains getting protected, you get a 2.5% per annum interest. Of course, that is taxable, but at least there's some return that you're getting with your money. The good thing about sovereign gold bond, let me mention, is that they are also traded in the secondary market. So it's possible for you today to get, for example, purchase a secondary gold bond which is maturing, say, in 5.5 years. So you don't have to hold for the entire 8 year period. Even those bonds, if you hold on till maturity, it's tax free when you sell it on maturity. So keep that in mind. If, however, you sell it in between, as long as you've held for more than 12 months, it's long term capital gain. And if it's less than 12 months, it just gets added to your short term capital gain at the slab rate. Uh, the simpler amount or the way to invest where you can exit easily are ETFs or mutual funds. So ETF is essentially buying it through the stock market or through a trading account, a demat account, and you're trading in the ETF. So you could invest in that. There, if you hold it for more than 12 months, it's long-term capital gain. In the mutual fund route, you can buy really small units, small amounts at any point in time. But in mutual funds, the only issue is that only after 2 years it becomes long term, and therefore the long term capital gains kicks in after 2 year period. Uh, and physical gold also, I think, if those who are following it from a tax standpoint, if you hold for more than 2 years, it becomes long-term capital gains tax. So, in the case of sovereign gold bond, where we said 12 months becomes long-term, if you do less than 12 months, it's short-term capital gain. The same thing with ETF. Less than 12 months, it's short-term capital gain, whereas the other two, which is mutual fund or physical gold, more than 24 months, less than 24 months is short-term capital.
Right. Loy, while some of the instruments might have a tax advantage or an arbitrage advantage, keeping everything in mind, if one is investing for the long term, what would be the best recommended product to choose? A and B, would you recommend one or would you recommend a mix of ETFs and funds and maybe SGBs as well? Because that
So
becomes
I,
too much to manage.
so I think if you must have a good advisor, then you don't have the problem of managing. But
Yeah,
at the
yeah,
same
yeah.
time, I would think that the SGB seems like a no nonsense, fill it, shut it, forget it, if you're willing to hold on for a long period of time, because then I don't have to worry about capital gains tax at the time of maturity. Um, so if I'm disciplined enough to hold for that entire period of that SGB, then SGB is a good option to go ahead and do.
Right.
If I'm doing it with a shorter term objective, that there's a possibility I might need the money earlier. While I did mention that ETF has a better long term capital gains tax treatment than mutual fund, the problem with ETF sometimes is the price differential because of liquidity not being as good.
Robust.
Sometimes the price differential is more, so you might not make the full amount of money that you ought to have made with your investment in
Right.
gold. So that's the only warning on ETF.
Right. So this is what brings me to my next question, right? Why a lot of Indian families invest in gold because they believe gold bars are liquid in that sense. If you need the money today, you can go to a jeweler, sell it, and you get your money, right? Are financial gold instruments as liquid? Is it T plus two as it is with equity? Price discovery, of course, is a separate discussion. But if I want my money today, will it hit my bank account in T plus two? Is what I must understand.
Yeah, so if you're doing ETFs and or sovereign gold bonds and you're trading in the market, it's exactly the same as you would do with any, say, stock or bond, etc. So once you sell it, pretty much the next day you're getting your money. Whereas in the case of the mutual fund, yeah, it is a T plus two payment out for the mutual fund if you're selling it. So it's
Any
not difficult.
minimum, right?
Sorry.
Any of these products have a minimum investment or minimum ticket size in that sense?
No, I think for ETFs, you can do one unit itself. So whatever the
Ah,
price of
okay.
that one unit.
Yeah.
Mutual funds, I think, is 100 or 500 rupees. It's
Okay.
really small. A sovereign gold bond, it's one bond. So depending on what the price of the bond is, again a few thousand rupees. So pretty much you can do that. There are maximums in the SGB. You can't do more than 4 kg equivalent. The price of 4 kg, you can't do more than that. But otherwise, there are no limits in the ETFs or mutual funds, and of course in physical world.
You talked about how gold has had such a good run. The global gold prices are 49% this year. It's all good when things are going up, right? And we're seeing that as we speak because equity markets are going through a very, very strong bout of profit booking and investors are nervous. Let's also not forget that all the new investors we've seen across most asset classes are new investors. So, what I want to understand from you is while the road behind is pretty glorious for gold, looking ahead, what are the risks one should be mindful of when they make that investment into gold?
No, so I don't think the road in the past is so rosy as well. So I just want to draw attention to the prices of gold in the international markets. So as far back as September 2011, the price of gold in the international market was $1,800 an ounce. It fell in the next 4 years down to 1,050, and then for it to come back to $2,000, it was only in August 2020 that it crossed that price. So it took 9 years almost for it to have zero return. So if I had invested in September 2011 at 1800, it's today 2750. So you pretty much made 50% return only in the last 13 years. So it's not necessary that you will always have this 50% in 1 year return that you have made. So I think you have to be very, very careful about. Gold never crossed $1,800 or $2,000 for a long time, and it only crossed it finally in October 23. And after that, it's sort of had a runaway rally. I think one has to also be careful and be aware that one of the other things that gold has a sort of negative correlation to is dollar. So if at some stage people feel that the dollar is a safer haven, then you will again see prices of gold dropping, and it's fairly intricate. There are periods where both go up and both go down. So don't just directly correlate one price to it. I think it's also a question of, since at the beginning of the show you spoke a little bit about silver, which gets used in manufacturing. If you're expecting growth really to pick up in the world markets, then silver probably will do better than gold. But the problem is there's uncertainty. Maybe the growth won't happen as much, and therefore gold might continue doing well. It's all a question of unreal returns. When you start
Hmm.
having unreal
Yeah,
returns, which we've seen in the Indian equity
yeah,
market,
yeah,
you
yeah.
start seeing corrections.
Right. Louis, so if one, and I want to talk to you about silver for a minute because, like you said, the use of it is also industrial. But silver prices have been very volatile historically, unlike gold, right? And the big selling point of gold is it's a hedge and it also adds some stability to a portfolio. Silver doesn't have the same attribute, but is a proxy to gold in many ways. So if I have 10% of my portfolio going into precious metals, would a 5% split to gold and a 5% split to silver be advisable, or that would be too much?
So I think first and foremost in the financial market, silver got added only very recently.
Hmm.
Otherwise, you had to sort of trade with it physically, and that was, definitely had its own element of risk. And as you mentioned, yes, the price volatility of silver is a lot more than gold. So one has to be really careful about that. So I would think that unless you are a really aggressive investor who believes that there is growth in the world, I don't care about all the negative view in the markets or the uncertainties in the world. The world will continue to grow. Then maybe you can do, I think even the 50-50, I would hesitate to suggest. But I would normally think that silver should be a much smaller element of that precious metal as compared to gold. Uh, if you had to weigh between the two, maybe even
So why?
80-20 in favor of
Right.
gold.
Now, Lubai, recently everyone's talking about the multi-asset fund. Are you seeing there's any merit in that one? Because that is not just gold, right? It gives you a little bit of a few other assets or commodities or metals in that sense. Would you recommend it?
See, I think what happens is that if you have an advisor, and I'm speaking now from an advisory hat standpoint, I know what sort of allocation I need to make for my client. I'd much rather do it cleanly. If I want 10% in gold, I want 30% in debt, I want 60% in equity, or I want 50 in domestic equity, 10 in international equity. I'd rather do it clean. I don't need to get proxy investment into it. But if I'm managing on my own and I'm confused whether what sort of allocation, how should I split it? Is there an auto balancing option available in those multi-asset funds? Then maybe yes, you could look at that. And unfortunately, we look at the flavor of the season based on past returns, and they are frankly a very terrible way of deciding where to invest, because you are never investing for the past, you're always investing for the future. So you need a little bit of outlook rather than look back.
Right. Lavoy, also, I know it's always tough to predict, and it's also not what advisors like to do usually. But with your disclaimers, where do you see gold prices in the next 3 to 5 years?
I think because the last 5 years have been really so good, I don't think gold will give us those type of returns. So 5 year returns internationally is around 114% at this point in time. I don't see that happening. But who knows? I may be wrong, and there may be blow ups in multiple places of the world, and everybody will be very happy with gold. So I don't know. See, it's really in uncharted territory at this point in time. But I won't go ultra bullish on gold. I'm sure there will be different pockets of investment that will be available in the market. It doesn't have to be all Indian equity. It doesn't have to
Hmm.
be all in safe assets. A good mix is always
Right.
good
And
for
I think
investment.
key to a stable portfolio and that creates wealth is diversification, right? Across asset classes, across geographies. So that's what you want to keep in mind. And you got to look at returns at a portfolio level as opposed to a product level. But gold has been an important product historically in this country. Like I said, tomorrow is Dhanteras. So with Loai's blessings in many ways, you should go out and buy some gold. Well, a gold sikka would be a good idea if you want it only for purpose of religion in that sense. But other than that, adding gold to your financial portfolio is also recommended. Luai, we have a bunch of questions. I'm going to start with Akash Kotian has written in, and he says, how are the moves of gold and silver correlated, and which one is safer for the long term?
So definitely the volatility is a lot more with silver. So from a safety standpoint, I would first look at the risk side, and therefore silver does carry a lot more risk. So then I would pick gold if I have to choose that. Correlation wise, there are graphs that are available which compare the price of gold and silver. And whenever I have looked at them, they have not been sort of in one sort of straight line. They've been all over the place. So I think there is very little correlation. There are times where you will prove how the correlation is very high, and there are times where you say, no, it's totally opposite. So the way I think about it, silver is the growth asset, gold is the safety. So how can they both go up together at the same time?
Well, one question from Batul Kapasi. She says, does it make sense to invest in silver given the recent rally and the current prices?
Same answer. So I think that if you're a believer in world growth, and therefore silver as a industrial use is also going to pick up, then yes, silver. Otherwise, you know, last 1 year returns the way it has been, one needs to be a bit careful.
Hmm. Thank you very much, Luai. Thank you for talking to us. Have a great festive week. Happy Diwali, happy Dhanteras. May this year be a prosperous one.
Yeah, next time we'll see you with a gold necklace, right?
100%, even though I prefer diamonds, but sure, yes, I'm buying SGBs, remember?
Sure. All the
But
best.
thank you very much. All the best. See you soon. Thank you. Bye.
Bye.